Welcome to the deep dive. Today we're really digging into Sable Offshore Corp, SOC. We want to understand what exactly happened with this stock between, let's say, September 2024 and September 2025.
It's a really interesting period to look at.
It is because our sources show this huge paradox right from the start. I mean, you look at the closing price, $23.91 on September 19, 2025. That's up only 1.2% from the year before, $23.63.
Yeah, on paper, it looks almost like a non-event. Very quiet.
Okay, let's unpack this. Because that tiny gain, it hides one of the wildest, most, frankly, gut-wrenching rides we've seen in the market.
Oh, absolutely. Anything but dull. That low return is, well, it's completely deceptive if you were actually holding SOC. Whiplash is the word.
Whiplash, yeah.
Within that 1 year, the stock soared to a high of $35.
$35.
But it also crashed down to a low of $16.26. That kind of range. Well, you need a titanium stomach as an investor.
No kidding. And the numbers, the actual metrics for instability back this up, right? It wasn't just a feeling.
Exactly. The data confirms it. SOC had weekly volatility of 12%.
12% weekly.
Yeah, and just to give you some context, that's higher volatility than 75% of all U.S. stocks.
Wow.
So this isn't just a stock that moves a bit, it swings, sometimes violently, based on, every little bit of news.
But here's the thing, and this is key, I think. We need to get this out right away. Despite all that chaos, the dips, the peaks, SOC actually delivered really strong relative performance.
That really is the aha moment here. The company significantly outperformed the broader market, beat the S&P 500 by nearly 39%, 38.77% to be exact, over that same year.
Okay, so even with the crazy swings.
But even with the swings, it suggests that while the ride was rough, the underlying momentum, probably driven by the operational stuff we'll get into, kept it ahead of the pack. Investors, it seems, were willing to stomach the chaos if they believed in the end game.
That makes sense. That strong outperformance suggests the market was maybe looking past the daily noise.
Yeah.
Focusing on something more tangible.
Precisely.
So let's pivot then. Let's look at the core business, the operational reality. SOC's main focus is that San Ynez unit, the SYU, that big offshore asset in California.
That's the heart of it, yes.
And the single biggest thing, the development that must have fueled that confidence in the outperformance, was getting production back online, right?
That restart was everything. It was basically the whole investment thesis for holding the stock. And crucially, they executed it successfully.
Why did that happen?
It was May 2025, after a long, long shutdown, that SYU finally started operations again. And it wasn't just an announcement, we got actual numbers. Platform Harmony initially flowed at 6,000 barrels per day.
6,000 a day right off the bat.
Yeah, and what's fascinating here is the momentum they built. It wasn't just a quick flicker. By August 2025, just 3 months later, they'd already pulled up 220,000 barrels.
Okay, that's significant volume.
It is. And importantly, this was supported by finishing the necessary repairs on the Los Flores pipeline system. The infrastructure had to be ready. This wasn't luck. It was complex engineering making it happen.
Right, getting that infrastructure back online, especially offshore. There's a lot of risk there. So that success must have boosted confidence massively. Did we see that in their forecasts?
Oh, absolutely. We saw it in a huge guidance upgrade. It showed how confident the company itself was. They essentially doubled their expectations for the second half of the year.
Doubled.
Pretty much. They initially guided for the second half of 2025 at 20,000 to 25,000 barrels of oil equivalent per day, BOED.
Okay, standard measure.
You're right. Then they bumped that up dramatically to 40,000, 50,000 BOED.
Wow.
Doubling your expected output isn't just tweaking the numbers. It's basically saying, okay, the problems are solved, the engine is running.
Firing on all cylinders.
Exactly. And this wasn't just about production, it led directly to sales. Sable expected to fill up about 540,000 barrels of storage by mid-June 25.
And start selling soon after.
Yep, resuming actual oil sales in July. That successful ramp-up, that's what really drove the stock's relative strength, despite the bumps.
It really does sound like a major operational win, which I guess makes the financial side even more complicated. Because restarting platforms, fixing pipelines, that costs serious money. Billions, potentially.
Oh, absolutely. It's incredibly capital intensive.
So we have to look at the financial strain that came along with this operational success.
You have to.
Looking at the quarterly reports, you see exactly where that hit.
Yeah.
Sable reported pretty big net losses, $109.5 million in Q1 2025, and then an even bigger loss, $128.1 million in Q2. So this wasn't a profitable year by any stretch. The earnings data really shows that stress.
No, the cash burn to get those operations going again was intense. It meant their trailing 12 months earnings per share, the EPS, stayed negative, about negative relevant 1 cent,
Still in the red?
deep in the red. And the forecasts suggest, the squeeze isn't over. Next year's EPS is predicted to be around negative $1.57.
So more losses expected.
Right. These aren't the numbers of a stable dividend-paying company. This is a company in a very high-stakes, very expensive transition.
And that transition needed cash, a lot of it, to cover the spending and manage their debt. How did they get that liquidity, and what was the cost?
Well, that's the crucial balancing act. To handle the losses and fund the restart, they did a public offering, sold 10 million new shares at $29.50 each.
Okay, so bringing in new money.
Exactly. It raised a pretty substantial $282.6 million in net proceeds, and that capital was absolutely critical.
But there's always a consequence with issuing new shares, isn't there?
There is dilution. That's the trade-off the market had to accept. Issuing 10 million new shares means existing shareholders suddenly own a smaller slice of the company.
The cost of survival, essentially.
No, you could put it that way. It was the price for solving that immediate liquidity need. And they really needed it. Their short-term debt was huge.
Yeah.
$875.6 million.
Wow, nearly $1 billion in short-term debt.
Now, we should mention they did have some cash on hand to offset that, about $247 million, but still a very significant debt load.
Okay, so on one hand, you've got the operational success, the restart, the capital raise, keeping them afloat. But on the other, heavy losses, massive debt, dilution for shareholders.
It's a real tug of war.
Which brings us back to that extreme volatility we started with. Let's talk about the external things, the headwinds that kept knocking the stock around. I mean, a 14% drop in one day. That's not just market jitters.
No, that's specific event risk.
Here's where it gets really interesting. We have to start with regulatory risk, right? Operating in California.
Especially offshore California. You're under the very watchful eye of the California Coastal Commission.
And concerns from the commission were a constant issue.
A major, consistent headwind. It definitely fueled the volatility. In fact, at one point, specific regulatory concerns from them directly triggered that massive 14% single-day price collapse.
It just shows, in this kind of industry, political risk can hit just as hard as, maybe harder than, actual earnings news.
Absolutely. And that's compounded by legal risk, too.
The lawsuit?
Right. There is an ongoing class action lawsuit. It alleges the company misrepresented oil production in the past. Now, whatever the final outcome, just having that legal cloud hanging over them puts pressure on investor confidence. It makes people question past reports.
Understandable.
And you could sort of see this uncertainty maybe reflected in how some big players acted. We saw some institutional caution, specifically Pilgrim Global ICAV. They're a 10% owner, sold off about 167,000 shares.
When a major insider starts selling.
It raises eyebrows. It suggests maybe some worry about the longer-term risk, regardless of how good the recent production numbers looked.
So it's this constant fight. Operational wins versus these regulatory and legal threats.
Yeah.
How did the market react to this push and pull? You mentioned the 14% drop from regulatory news. What about the good news, the operational success?
Well, the reaction to the operational wins was, frankly, explosive. It really proved the market wanted to believe in the recovery story. Despite all those legal and regulatory clouds, when you had analyst upgrades combining with that production restart news, the stock surged 28.5% in a single day.
28.5%. Wow.
Yeah. It shows a pretty clear pattern. External risks could hammer the stock, but successful execution, that sent it soaring even higher. The market was rewarding progress.
And what about the analysts overall? Were they generally positive despite the risks?
Overwhelmingly positive, actually. The analyst community as a whole keeps a strong buy rating on SOC. They seem to be looking through the short-term noise.
But are they all on the same page about where it's heading?
Well, that's where it gets interesting again. There's a lot of conviction, but the range of that conviction is huge.
Okay, tell us about the price targets. What does that spread reveal?
The 12-month price targets are, well, pretty ambitious. They range from $30 on the low end all the way up to $47 on the high end.
$47. That's almost double the recent price.
Exactly. You have, for example, Benchmark out there with that $47 target. TD Cowen is more conservative, relatively speaking, at $40. But even that implies massive potential upside from the current price point, anywhere from 25% up to maybe 97%.
That's a huge difference in outlook, a $17 spread between targets.
It really shows a fundamental disagreement among the experts analyzing it. probably about the probability of those regulatory issues flaring up again.
So some are betting heavily on smooth sailing and hitting that $47.
Right, betting on uninterrupted production ramp up. Others are clearly pricing in more risk, maybe significant risk, from the Coastal Commission, which pulls their target down.
Any other signals supporting the bullish view?
Well, even the Danilfin AI score, which is purely quantitative, seemed to lean positive. It came in at 7 out of 10. That suggested something like a 58% chance of SOC outperforming the S&P 500 over the next 3 months.
Hmm. Okay, that really paints the picture of the whole year, doesn't it? Just a pure volatility story. This constant battle, operational wins and analyst hope pushing up against these nagging regulatory and legal risks pulling down.
That's a perfect summary. A real roller coaster.
So what this deep dive really tells you, the listener, is that this stock, based on this data, was clearly a high-risk, high-reward play. It demanded, and probably still demands, a very high tolerance for risk. You've got the negative earnings in the short term, that huge debt pile, and just extreme volatility that, well, it tests your nerves.
Definitely a psychological challenge.
Yeah. The source material put it really well. It's a test of patience. The constant ups and downs are a huge psychological challenge, but you're holding on for the chance that it's a home run.
Captures the feeling perfectly.
So where does that leave us? What's the final thought here?
Well, if we connect this to the bigger picture, everything, the whole stock performance, hinges on turning those barrels of oil equivalent, those BOEDs, into actual sustained revenue. And crucially, avoiding another major shutdown, regulatory or otherwise.
Right.
The core tension seems to be this. Was the successful restart back in May and that big guidance upgrade enough to fundamentally change the game, especially regarding California's political stance on offshore drilling?
Will the market, will analysts see it as proof the corner has been turned?
Exactly. Or will they see it as just a temporary victory in a long regulatory fight that could still clamp down hard on future production? Answering that question, I think, is what will ultimately decide if those ambitious $47 price targets ever actually happen.